Wells Fargo today is a product of tens of hundreds of mergers and acquisitions over the decades. We're a diversified North American financial services company. We have one of our industry's most extensive distribution systems: stores, ATMs, phone banks, and of course the internet.
Wells Fargo is among the most recognizable megabanks in the world. Based in San Francisco, it dates back to 1852 when Henry Wells and William Fargo founded the company.
Our culture today owes so much to all our predecessors and the talented, loyal, caring folks who've gone before us.
I was told to instruct both my tellers and more of my personal bankers that they needed to hit their goals no matter what.
We describe our culture in a document we've been living by for more than 2 decades, our vision and values. Our vision is simple. We want to satisfy all of our customers' financial needs. We want to help them succeed financially. We want to be the premier provider of financial services in every one of our markets. And we want to be known as one of America's great companies.
Thank you, Mr. Chairman. Mr. Stump, the Wells Fargo Vision and Values Statement, which you frequently cite, says, quote, "We believe in values lived, not phrases memorized. If you want to find out how strong a company's ethics are, don't listen to what its people say, watch what they do." So let's do that.
To dozens of employees all around the country in the ensuing weeks before we did the large investigative piece that was published in December of 2013.
Because if you have happy, satisfied, loyal, and caring team members, then you'll have happy, satisfied, and loyal customers who will give us more of their business and rave about us to their family and friends and business associates.
For years, Wells Fargo has used a questionable practice known as cross-selling, where the firm aggressively tries to sell multiple products to existing banking customers. These practices include things like encouraging an unsophisticated customer with a simple checking account to take out a mortgage on their home, whether or not the customer needs a mortgage at all in the first place.
It had to do with extraordinary pressure coming down from regional managers onto the branch managers, who then pressured the frontline employees and in some cases coached them in how to improperly goose up their sales figures.
Like what? Like how do they coach them? What do they say?
Well, there are, one of the things they did was to tell people wrongly that they couldn't open a certain kind of account unless they took a credit card or a debit card or something. In other cases, they coached them in how to use the employees' information to open accounts without the customers knowing.
People are central to our vision. People are our greatest competitive advantage. It's not products, not technology, which can be easily copied. No one, however, can duplicate the talent and caring and expertise of our great people.
It was the pressure of having to hold the team accountable to very unrealistic standards.
There might be conference calls 5 times a day. Like the managers would have to be on a conference call at 8 o'clock. And then there was a mid-morning check-in call. Then there was a 12 o'clock call. Then there was a 2:30 call, and then a 5 o'clock call. What did you do?
We believe our people can out-execute our competitors every time because our people care more than our competitors do.
For years, Wells
account unless they took a credit card or a debit card or something. In other cases, they coached them in how to use the employees' information to open accounts without the customers knowing.
For years, Wells Fargo has used a questionable practice known as cross-selling, where the firm aggressively tries to sell multiple products to existing banking customers. Practices include things like encouraging an unsophisticated customer with a simple checking account to take out a mortgage on their home, whether or not the customer needs a mortgage at all in the first place. Wells Fargo measured its own business success in part by the number of distinct products sold to the average customer, encouraging this predatory marketing scheme. As a result, for a long time, Wells had been considered the best cross-seller in the banking industry. Starting from the top-level management, Wells Fargo branches were encouraged and pressured to sell more products to banking clients. They cultivated a cutthroat corporate culture that pressured branch employees to strive to sell at least 8 different products to each customer. The most intense pressures came as the result of the banking giant Dick Kovacevic, CEO of Wells Fargo from 1998 to 2007. Under Kovacevic, Wells Fargo viewed mortgages, savings accounts, and credit cards as products to be sold to banking clients, who he viewed as customers.
We all know about Wells Fargo's fake account scandal.
We put our customers at the center of everything we do. We start every discussion, make every decision, invest every dollar based on what's right for them. This isn't just about transactions. This is about lifelong relationships.
Possibly as early as 2011, Wells Fargo began opening customer accounts without their consent. They would take the banking and identification information of existing customers and open new, fee-bearing accounts for different products and services.
So we're not just selling checking accounts or investments or insurance or mortgage products. Our product is actually service. Our value added is financial advice. And our competitive advantage is our people. So we're not just selling.
In thousands of cases, Wells Fargo ordered new credit cards for clients without their consent. These credit cards were issued to clients who were pre-qualified, and thus they could be issued without the client going through an application process or even knowing about it.
At Wells Fargo, sales and service are inseparable. More sales do not always lead to better service, but better service almost always leads to more sales.
Since this massive years-long scam came to light, you have said repeatedly, quote, "I am accountable." But what have you actually done to hold yourself accountable? Have you resigned as CEO or chairman of Wells Fargo?
The board, I serve at
Have you resigned?
No, I've not.
All right. Have you returned one nickel of the millions of dollars that you were paid while this scam was going on?
Well, first of all, this was by 1% of our people.
That's not my question. My question is about responsibility. Have you returned one nickel of the millions of dollars that you were paid while this scam was going on?
The board will take care of that.
Have you returned one nickel of the money you earned while this scam was going on?
And the board will do...
I will take that as a no then. Have you fired a single senior executive? And by that, I don't mean a regional manager or a branch manager. I'm asking about the people who actually led your community banking division or your compliance division.
We've made a change in our regional, to lead our regional bank.
I just said, I'm not asking about regional managers. I'm not asking about branch managers. I'm asking if you have fired senior management, the people who actually led community banking division, who oversaw this fraud, or the compliance division that was in charge of making sure that the bank complied with the law.
Carrie Toll said...
Did you fire
No.
any of those people? No. Okay. So you haven't resigned. You haven't returned a single nickel of your personal earnings. You haven't fired a single senior executive. Instead, evidently, your definition of accountable is to push the blame to your low-level employees who don't have the money for a fancy PR firm to defend themselves. It's gutless leadership. In your time as chairman and CEO, Wells has been famous for cross-selling, which is pushing existing customers to open more accounts. Cross-selling is one of the main reasons that Wells has become the most valuable bank in the world.
Today, Wells Fargo has nearly 4,800 bank branches open across the country. Changes to American laws allowed Wells Fargo and other banks to open new and riskier wings that trade securities and derivatives. While one division of Wells Fargo trades, another may be helping the government execute things like the Paycheck Protection Program. But at the core of this institution sits a traditional bank with federal insurance for its depositors' funds. In 2021, Wells Fargo managed average deposits of $834 billion. They used these deposits to go out and make more money. Wells Fargo's wide footprint makes it centrally important to the United States, and that made reports of a multi-million customer scam at the bank headline news in recent years. Today, Wells Fargo has nearly 4,800 bank branches open across the country. Changes to American laws allowed Wells Fargo and other banks to open new and riskier wings that trade securities and derivatives. While one division of Wells Fargo trades, another may be helping the government execute things like the Paycheck Protection Program. But at the core of this institution sits a traditional bank with federal insurance for its depositors' funds. Wells Fargo's wide footprint makes it centrally important to the United States, and that made reports of a multi-million customer scam at the bank headline news in
I want to take a look at your time at Wells Fargo. From 2011 to 2014, the height of when Wells Fargo was cheating customers by opening fake accounts, you served as the chief financial officer. And as CFO, you spoke to potential Wells Fargo investors a lot. On those calls, you aggressively promoted Wells Fargo's ability to open up new accounts, didn't you?
People were feeling so pressured to meet sales quotas that they were cheating.
We're talking about a scandal here that involves thousands of their employees cheating tens of thousands of customers out of money and making millions of dollars doing it for the bank.
Reports suggest that up to 3.5 million fake accounts were opened by Wells Fargo. That said, it wasn't the only bank opening up fake accounts at the time.
Chairman Brown, we regret, and I take full responsibility that we did open up unauthorized bank accounts. It was going back to 2010.
But at Wells Fargo, at least in the eyes of the government, a wider and more troubling pattern was emerging.
2016, the Consumer Financial Protection Bureau announced that they had issued a $185 million fine for the bank for illegal activity. However, the fine was nothing more than a drop in the bucket for Wells Fargo. They had opened literally millions of fake accounts over the years. In the single quarter leading up to the point when the fine was issued, Wells Fargo reported $5.6 billion of net income. Divided out amongst the quarter, the $185 million fine was paid off in only 3 days. After the scandal was uncovered, the scale and blatancy of the fraud was so galling that multiple major government regulators and institutions opened up further investigations. CEO John Stumpf was called before the Senate Banking Committee, where he was grilled by Democratic Senator Elizabeth Warren and Republican Patrick Toomey. Toomey said that he doubted Wells Fargo's claim that 5,300 employees, which Wells had since fired, acted independently without directions from management. Warren, meanwhile, called for the resignation of the CEO and asked the Federal Reserve Chairman to restrict the bank's corporate growth under the current CEO. The House Financial Services Committee also investigated the bank further in 2019, 3 years after the revelations. The chair of the committee, Maxine Waters, called for the dismantling of the bank and prompted the resignation of Wells Fargo's chairwoman 3 days before congressional hearing.
According to Wells Fargo's own investigation, by July of 2016, you knew that thousands of employees had been fired for opening fake accounts and other sales violations. You knew aggressive cross-selling goals were to blame, and still, you publicly said the bank didn't have a problem. Sloan, you were asked about pressure on employees, which caused the fake account scandal. We all know that now. It's public. You knew there was a problem, and when you were asked about it, you lied. This is about personal responsibility. Wells Fargo cheated millions of people for years. The Federal Reserve should remove all of the current board members who served during the fake account scam. And Mr. Sloan, you say you've been making changes at Wells Fargo for 30 years, but you enabled this fake account scam, you got rich off it, and then you tried to cover it up. At best, you were incompetent. At worst, you were complicit. And either way, you should be fired.
Tonight, the country's fourth largest bank, Wells Fargo, is paying up, agreeing to a $3 billion settlement with the Justice Department and the SEC after employees under pressure to meet sales goals created millions of fraudulent bank accounts between 2002 and 2016.
Simply put, Wells Fargo traded its hard-earned reputation for short-term profits and harmed untold numbers of customers along the way.
According to authorities, inside Wells Fargo, employees called it gaming, forging customer signatures, creating PINs to activate unauthorized debit cards, and moving money to unauthorized accounts. None of the $3 billion penalty will go back to defrauded customers. In a statement today, Wells Fargo's new CEO called the bank's past conduct reprehensible and wholly inconsistent with its values and promised to ensure that nothing like this happens again.
But tonight's fine does not clear individual executives from further investigation. And the Federal Reserve continues to ban Wells Fargo from growing any bigger until it's reorganized the company to prevent this abuse from repeating itself.
Wells Fargo shares climbing after hours after the bank announces John Stumpf will step down from his posts as CEO and chairman effective immediately.
But Laura, explain to me exactly how it is effective.
Wells Fargo shares climbing after hours after the bank announces John Stumpf will step down from his posts as CEO and chairman effective immediately.
But Laura, explain to me exactly how it is affecting Americans. I mean, I'm not saying this is a good thing at all, but as I understand it, the people they opened these accounts for didn't lose money. It didn't take money out of their accounts. And now Stumpf also says it didn't affect revenues for the company. What was this about?
Right. Not certainly as big as big of a deal as some of these really huge losses from the London Whale or from Goldman Sachs Abacus CDO. I mean, it's not the same kind of thing, but I think it's a little bit like Americans can look at this and say, look, this happened to someone I know.
Back in the Watergate days, back in the olden days, what they said is, okay, who knew what when? Right. So that's my question about Wells Fargo. How far up the line did this go?